Chapter 9 looks at basically the long-term assets, specifically property, plant, and equipment. That's the bulk of what we're going to be doing here. And then we do discuss intangible assets in this chapter as well, which is always interesting. But again, most of what we're going to be doing is in the first two objectives. The chapter, even though it has 5 objectives, most of the work is in the first 2. So this is what we're going to be doing today, to focus on the first 2 objectives. Okay, so here we go. Objective 1 talks about plant assets. Now we talk about the term plant is somewhat an old term, meaning like factories, very large buildings where things were made were called plants. They still are, it's just not as common a term as it used to be way back in the day. But plant assets are part of that property, plant, and equipment. These are long-term assets. When I used to be in your shoes, we used to just call them fixed assets because they weren't going anywhere and they were going to last a long time. But in essence, plant assets have a physical substance, so you can actually, they have a physical quality about them. They're used in the operation of the business. It's not meant to be for sale to customers. And so when we're talking about these plant assets, they're going to be used for a number of years, okay? And they're going to be providing some type of service to the company over that, over those number of years, right? So when UPS gets a truck, delivery truck, they know it's only going to be useful to them for a certain number of years, in which case it has to be replaced. If you're a pizzeria and you buy pizza ovens, you know those are going to be useful to you. They're going to provide service to you for a number of years, but pizza ovens don't last forever, right? So again, eventually maybe 10 or 15 years down the road, they're going to need to be replaced. So this is what we talk about in terms of providing service for a company over a number of years. Eventually, you're going to need to replace plant assets. The only exception, as you'll see, is land, because land in and of itself is always useful. You can take, a building is not, just because it's on the land doesn't mean it's land. Land is land. We actually separate all of them. You'll see the accounts today. But land always is available to provide a service to the company. So you're never going to need to, in essence, replace the land. The only exceptions for that is if you're a natural resource company. So you are you're a gold mining company, or you're an oil company that you're drilling for oil. The reason you bought the land is for the natural resources that are in the land, in which case it will run out eventually. But we're not talking about that here, but that does exist. Plant assets are a very, very important part of a company's success. Again, depending on how many companies you look at here, they're only listing a few. Wendy's tend to, look, there's lots of plant assets at your Wendy's in terms of a percentage of total assets. Why is it so large? Well, because if you think about a Wendy's, you have the building, you have the land, you have the building, you have all the refrigeration systems, the ovens, the grills, the machines that make the Frosties. I'm getting myself a little hungry for that now. You have countertops and tables and all types of equipment there that you need. So yeah, Wendy's is going to have a lot of plant assets because that's how it works. JetBlue here, again, your airplanes are your biggest. If you're an airline, you're going to have a lot of money tied up in airplanes. It's usually how it works, right? So that's going to take up a large percentage of your total assets, and that makes perfect sense. Makes perfect sense. I don't know when this was done. I'm assuming that has actually grown for Microsoft, since they've had a bunch of Microsoft stores open since this time. That's the problem. They don't put a year on. They use this data over and over again on all the books, and they don't put a year on it, which I think they should. Just to understand, when you see equipment or building on the balance sheet, what you're seeing is literally what they paid for it. You're not actually seeing the current value of the building or equipment today. We're not talking about market value in accounting. When we do our balance sheet, we're focused in on what we pay for it, what it's cost. So we use something called the historical cost principle, which means that when we buy things like land or a building or equipment, we're recording that at its cost. Now, the word cost is interesting because everyone thinks about cost in their own way, but literally everything you need to spend to get that, what we call ready for use. That's the standard. It has to be ready for use. And so that's what you're going to learn about today as well. I'm going to be talking about the difference between revenue and capital expenditures on a future slide when it actually comes up. So again, cost, when it comes to things, really we're looking at more than just the cash price, and you'll see how that works. Although we are going to come up with another, we're going to run into another generally accepted accounting principle regarding fair value. And we're going to talk about that in the future. Okay. All right, so here's your first property, plant, and equipment account, land. Land is property. So when a company says they own land and you see land on the balance sheet and a number next to that, what is that? How do they get that number? Well, again, all necessary costs getting that land ready for use. Okay, so that's important to know. Ready for use is really a critically important feature to understand the costs here. So of course you are going to have a cash price. You buy land for cash, no doubt about it. But that's not the only cost you have for land. You actually have what we call closing costs, and closing costs is simply that legal process of legally transferring the title, which is the ownership of the land, from the previous owner to you as an owner. That's a legal process. There's attorney's fees, et cetera, that's involved in all of that, title insurance, other stuff like this. So very, very important to know you have that. Real estate brokers commissions, when usually you're buying property of any sort, land or buildings, oftentimes the seller is represented by a broker. You may even be represented by a broker. Anyway, the commissions are part of it because you had to pay it in order to get the land. And again, that ready for use standard comes in here. If there's anything stopping you from using the land right away, meaning there's back taxes on that land, and you have to pay that you've agreed to pay that as part of the deal, that becomes part of the cost of the land. I'll throw another thing here. If there's junk on the land, in other words, it might be a rundown piece of equipment or a rundown, broken building or an old foundation, but no house there, and you got to remove it. That's also part of the cost of the land because it fits into that ready for use description that you're going to hear a lot about. So how does it all work? Well, let's take an illustration here where we have a manufacturing company that bought a piece of land for $100,000 cash. However, the property had an old warehouse that was raised. So to raise it means it was taken down and cleared out. The net cost of that raising was $6,000. It actually cost you $7,500, but you found $1,500 of stuff in that warehouse you could sell to offset the cost. So $6,000 was the cost of raising that warehouse. You had an attorney's fee of $1,000. You had a brokerage commission of $8,000. So what's the cost of the land? Well, everything you have to spend to get it ready for use. So that's the cash price of the land, raising that old warehouse because you can't use the land with that there. You got to clear it out. Attorney's fees and broker's fees. So what you'll see here is the total cost of the land would be all of it added together, $115,000. Okay. That's everything you had to do to get the land ready for use. That's just the land. Here's another account you haven't heard of yet. land improvements. This is an asset account. And basically, when we put parking lots or driveways or fences on a land, it gets debited to the land improvement account. Okay. And so that's an important thing, because a parking lot is not a building, it's not equipment, and it's not land. It's going to be, this is why we have another account, land improvements. So just know that. Okay. But for those of you that know anything about driveways, parking lots, fences, etc., they don't last forever. They have a useful life. What we call a useful life, we're talking about how many years is the business going to use it until it needs to be repaired or replaced? Most often replaced. Okay. And so, I don't know if you've driven on a bad road before, but that happens to asphalt. Cracks, it chips, it breaks, right? Get potholes, etc. So eventually parking lots, even driveways, other things need to be replaced. So they have something called a useful life. That's determined when you buy it. There are standards that are set across the industry for useful life of these types of things that accounting uses in determining that. Because it has a useful life and it's going to be needed to be replaced, that means that technically we're using that asset for a period of time to help us run our business, right? I mean, if Wendy's did not have a parking lot, did not have a drive-through, right? Didn't have any of those. It wouldn't be generating any revenue because no one would want to drive in, right? Things like this. So it has a useful life that's going to help the company generate revenue. Thus, the cost of these land improvements can be expensed over time. Over time. How much time? It's useful life. Remember, you can't expense it right away because you're going to be using it for a long time. And that's where expenses come in, right? You can only expense something once you've used it. And so, because you're going to be using a parking lot for 20 years, you can only expense it very slowly over time. That's what depreciation is really about. Okay. The next account you'll see is the buildings account. And buildings account is, again, everything all the costs that are required to get it ready for use. So there's two options there. You're either buying a building that already exists, or there's no building there and you're gonna construct one. So two really ways of looking at a buildings account. Buying a building that already exists happens a lot, right? So again, what's the cost of the building? Well, not just the price, the cash price, all those closing costs are part of it. Again, real property is registered property, and thus there's a legal title to it, and thus that's a legal process. There's costs involved. Those are closing costs, brokers' commissions. Some buildings are old and may not be up to current codes. What codes we're talking about? Building codes, electrical, other types of codes that way. So before you can actually use the building, remember, ready for use. Before you can use a building, it's got to be up to code. And so any type of remodeling that needs to be done, particularly of older buildings, sometimes you have to repair or replace a lot of things, whether it's a roof, plumbing, the wiring, the floors in some cases. Anything that has to get done before you can actually use the building is part of that ready for use standard. So all of that money gets put into the buildings account because you have to spend it to use it, right? So all of that is very important to understand when it comes to the cost of a building that this one's already existing. What if nothing exists? Well, then you got to build one, and that means you're going to have to, hire an architectural firm to come out and put all that stuff together and organize that. There are permits that need to be pulled that are going to cost money before you can start any type of construction. depending on where the building is and so forth, there's going to be certain types of excavation costs that are involved. Some of those are not so bad. Some of them are really big because, say, if you're in New York City or other places, you have to actually have your base of the building has to be cemented into the core of the earth. Otherwise, it shakes. You know, we can't have buildings falling. So, excavation can be relatively mild in terms of costs. They don't have to do too much digging, or it could be quite large. They have to be digging quite some time to secure that building into the bedrock. The equipment account, same principle. The cost of the equipment is everything you needed to get it ready for use. Ready for use. I can tell you, it's over and over again. So the equipment account would be including the cash price of equipment. Equipment is manufactured product, and so most states, when sales taxes were introduced way back when, basically the sales taxes were on manufactured products. And so since equipment is a manufactured product, sales taxes apply for states that have sales taxes. You're not doing business with someone across the street, so you're going to have it shipped to you. That's freight. Freight and insurance costs are part of the cost of the equipment. And the insurance, like I said, freight and insurance is part of that. And then once it gets to your location, it might need to be assembled. It might need to be installed. It might need to be tested. Hell, you might even need to train employees to use it. Certain pieces of equipment might need certain foundations. You might need to pour a special cement foundation to install the equipment. Guess what? All of those expenditures are part of the cost of the equipment. Why? Because you needed to spend it to get it ready for use. Okay, you couldn't use the equipment without doing all of that. So all of that cost is really what the equipment cost you. Here's an example here from a company, Leonard Company. They bought a delivery truck for $22,000, probably a small truck or used. Sales taxes were $1,320. Painting and lettering, $500. Motor vehicle license was $80, and they had an insurance policy for $1,600. But what's the actual cost of the truck? Right, the truck is the equipment. What did you need to do? You certainly need to pay cash for that. So the cash price is included. You had to put sales tax. You had to pay sales tax on that. So that's that. Almost all businesses now want their vehicles to be painted and lettered and documented accordingly. So that is also getting the truck. You need to do that to get the truck ready for use. What you don't see is the license, because the license is for the person, not the truck. I used to say trucks don't drive themselves until, of course, Tesla came around. But you know, even so, drivers need licenses. That's to get the driver ready, not to get the truck ready. So a driver's license would simply be an expense to a business because they're getting the driver ready to drive the truck and not the truck ready to use. And every time you buy insurance, you should know this, right? Prepaid insurance. Okay, good. So what it would look like on the books is, even though they spent $25,500 on all of this, as you see, only $23,820 is the cost of the truck. The license is an expense, and insurance is always prepaid insurance. Okay. So two things happen regarding spending money on equipment, property, plant, equipment you already have. One is it's going to need repairs. So if you have, it needs to be properly lubricated, and certain things have to be worked. Like if you have a truck, you're going to need to make sure tires don't last forever, oil filters, other types of things don't last forever. So you're going to be doing regular maintenance on buildings and equipment normally. So when you do a regular maintenance, you simply expense that as maintenance and repairs expense. It's just gone right now. However, there are some things that you might do that actually increase the useful life. You thought you were going to use an asset for 5 years, but after you've done something, you can actually use it now for 7 years. Okay, so if that happens, and an example of that would be you bought a truck. Say UPS bought a truck, they were planning to use it for 5 years. 2 years after using it, they had to rebuild the engine. So when you rebuild an engine of a truck, you're basically giving the truck a new engine. And if new engines can last 5 years, you've just prolonged the life of that truck. So that would be something called an addition and improvement, in which case those are debited directly to the asset account, the equipment account, or whatever, the building account, whatever you did, whatever was affected. So that's basically the difference. The ordinary expense is simply a revenue. This is called a revenue expenditure. This is called a capital expenditure. That relates to that earlier slide. But that's basically how we look at it. A lot of companies do lease. They don't have to buy certain equipment, they lease. Most cases, even though they're leasing assets, they actually have created an expense for that by the lease. So a lease gives them assets, but it also gives them a liability. And normally speaking, leased equipment is not normally put on the balance sheet. The asset, and basically it's an asset and it's a liability at the same time, and they basically cancel each other out. So they're not often reported on balance sheets. They can be, but they're not often. They are always reported in the notes. So many firms do use leases on a regular basis, and they need to report these types of things. So it is big business. It's normal. Lots of companies do it, but technically speaking, it's both an asset and a liability. It cancels each other out. All right, learning objective 2 is all about depreciation. There are a few methods of depreciation. We're only going to be focused on one. That's the good news. And the one we're focused on is the easiest one, but it's also the most common one that's used. We didn't pick it because it's the easiest. We picked it because it is the most common. So remember, these assets, these plant assets, are going to be used for a number of years. They have a useful life. They have a useful life. You're going to be hearing that term a lot too, useful life. Meaning that when we purchased the asset, we knew it was going to last. We were expecting it to last us X number of years before it needed to be replaced. So whether that's a parking lot, whether that's a stove, whether that's a truck, a delivery truck, whatever, we know it has a useful life. At some point, it's going to need to be replaced. So depreciation allows us to start allocating the expense of that asset over the time that we're using it. So again, we're talking about long periods of time, okay? Truck might be 5 years. Like I said, a piece of equipment like a stove, an oven in a pizza shop might be 10 or 15 years. Buildings might be, 25, 30 years. We're talking about very long periods of time. And so we can only expense a little bit at a time. Depreciation is really about cost allocation. It applies to everything that has a useful life. Land is always useful. Okay. Land is always useful. Check out the planet. It's been around a while. It's always there. It's always useful. But you can't say that for a building. You can't say that for automobiles or trucks. You can't say that for parking lots or driveways. They wear out. Right. So that's why it doesn't apply to land. So we're going to be looking at depreciation, okay, in detail. Understanding why or the factors that are involved in depreciation is important. You already learned in learning objective 1 how we calculate the cost. Okay. Learning objective 1 shows you how do we calculate the cost of the asset. The second thing we have to do is find out how long we're going to be using that particular asset. Okay, that's the useful life thing. After we've done using it, after say this truck we're going to use for 5 years, right? After 5 years of using it and using it quite a bit, as you see, it's pretty banged up in this last picture here compared to brand new. The question in accounting is, will it have any salvage value? Would it have any residual value after we're done using it? And the answer to that question is mixed. Sometimes yes, sometimes no. For example, even if we were going to be using computer equipment for 4 years, at the end of that 4-year period, the salvage value of the computer equipment is zero. Okay, zero. There's nobody in their right mind wants to buy a 4 or 5-year-old piece of technology. Okay, that's done. But that's not true for things like various pieces of equipment and vehicles. So like this truck, although it looks pretty banged up, you've seen that after businesses are done using vehicles, oftentimes they will be resold, right, in the marketplace. I see a lot of old cop cars that have been, redone and driven by usually older guys like to drive those things. So, basically speaking, it's not like it doesn't have a salvage value. Some assets do have a salvage value. It may not be very much when you're done using it, but there's something. So this all has to be figured out. Okay, that's why they're called factors. So 3 things: the cost, the useful life, we're going to look at it in years, and when we're done with it, is there any salvage value? Salvage value could be very low, could be zero. So once we know that, we can do depreciation. We can calculate our depreciation. There are a number of different ways of calculating depreciation, but as you see, the most popular way by a clear long shot, okay, right, no voter fraud here. Straight line method is clearly what's used the most by corporations, mostly because it matches the tax code better than any other method. But there are other methods. There's a declining balance, which a lot of people have heard about, is called accelerated depreciation. And there's something called the units of activity, which instead of using years, which is what straight line method uses a unit, like a number of miles on a truck, or the number of molds that a molding machine would use in manufacturing. It's a unit instead of years. So, but again, straight line is your goal, is to understand. So here's how it works. Here's an illustration. Bill's Pizza purchased a small delivery truck. How small? 13,000. Oh, do you wind that thing up? It's like a little crank in the back. Or maybe it has a string. You pull the string out of it, then it gets going. $13,000 for a truck? I don't know. I've never seen a $13,000 truck that isn't all beat up. But anyway, enough of my commentary today. So Bill's Pizza buys a small delivery truck for $13,000. They're going to use it for 5 years, right? In straight line depreciation, we use years. So they're going to use it for 5 years. That's the estimated life, useful life of it. After the 5 years is done, they're expecting it to have a salvage value of 1,000. Now, if they used the units of activity, they would look at it from a mileage perspective. But we're not. That's why the miles are listed here. It's because that's the unit in which they can also depreciate. But again, the only thing we're going to be looking at is straight line. Okay. So again, the cost, 13,000, salvage value, 1,000, number of years, 5. The only 3 numbers you really need to know. So to do the depreciable cost, the expense for depreciation is going to be the same every year, okay, under straight line. You take the cost, so that's the $13,000, minus the salvage value, which is $1,000. So that means that $12,000 of this asset is depreciable because this is how much that business is going to use. They bought a $13,000 truck. They're going to use $12,000 of that truck over 5 years to deliver pizza and sandwiches. So because this is what they're going to use, this is what's subject to depreciation. Okay. You take the depreciable cost, divide it by the number of years. Very simple. So what we have here is for every year that Bill's Pizza has this truck, they will have a depreciation expense of $2,400 per year. Now, this is assuming, by the way, this is a full year. So they had to buy it if they had a traditional calendar year, they would have had to buy this truck in January to expense all of this because this is expense is for all 12 months for a full year. Okay. So this is one way to calculate it. Your book explains it in this way. It takes, for straight line depreciation, you know that you're going to be depreciating $12,000 over 5 years. So that means if you look at 5 years, you're going to basically be expensing 20% of that value each year for 5 years. That's how they do the rate here. Okay. It doesn't have to be this complicated, but that's what they do. That means that every year, at the end of the year, they will have a depreciation expense for $2,400, and they will have a credit to accumulated depreciation for equipment for $2,400. Okay. Every year, they're going to have this, starting in 2017 all the way. Okay. So what happens, as you know, is that the expense accounts are closed at the end of the year, right? That's chapter 4, the closing process. But accumulated depreciation is an asset account. It just has a credit balance, contra asset account. So this always stays open. This is going to show us how much depreciation has accumulated over the years. So for every year we expense $2,400, every year accumulated depreciation is going to go up by $2,400 because it shows the accumulated depreciation. Okay. So again, each year we expense $2,400, you'll see accumulated depreciation go up $2,400. The most we can write off over 5 years is the $12,000 we said we were going to use. Okay. So accumulated depreciation will stop when we reach that total depreciable cost. Now, one thing you have to know is something called book value. Okay. And book value, basically speaking, is the difference between the cost of the asset and the accumulated depreciation. Okay. So remember, the cost of this truck was $13,000. We're going to depreciate $12,000 of it, but the cost was $13,000. Okay. After the first year, we have already written off or depreciated $2,400 of that truck. So the book value of the truck is $13,000 minus $2,400, $10,600. That's the book value of the truck. After the first year, it's depreciated. After the second year that we've depreciated it, and we'll make another journal entry, we're going to have $4,800 of accumulated depreciation. Now, when you do the book value, $13,000 minus $4,800, we're going to have $8,200 as the book value. This book value basically is the difference between what the cost was and how much we've already depreciated, which is going to show up in your accumulated depreciation account. Okay. So every year, the book value is going to shrink by whatever the accumulated depreciation is. The lowest the book value can go is the salvage value that you said you were going to use. Okay. So after 5 years of depreciating this truck, the most you can depreciate is $12,000, and the lowest the book value of the truck can be is $1,000, because that's how you set it up when you bought it. Okay, you have to keep your accounting the same. Does it mean you can this Can this company use it in 2022? Sure, but they can't write it off anymore. Sure, they can still use the truck if they want it, but it's done in terms of expensed. It's already fully expensed. Okay, so that's what's important to know about how this depreciation thing works. And again, there's an assumption that it's for a full year. But what if you didn't buy, what if you didn't have it for all 12 months? Well, that's only going to happen in your first year. Um, and so let's say Bill bought this on April 1st instead of January the 1st. So that means in the very first year, they actually only own the truck 9 months of the 12. Remember, the $2,400 is the annual expense, all 12 months. So it's assuming you've used it all 12 months. So if you've bought it later in that first year, in this case, you bought it in April, so you're only going to use it 9 months that first year. You can only expense 9 months of the 12. That's all this is said. What about that extra 3 months? Because you're going to expense it for 5 years. You just tag it on at the end, basically. So you still have this as a 1 full year, 2, 3, 4, 5. You still got 5 years of depreciation. It's just you're breaking up the first year into 9 months, and the carryover is going to be thrown into the last year. Okay, so that's only for what we call a partial year. So that would be at the end of 2017, our depreciation expense for a partial year will be the annual times the number of months over 12 that you've used it, in this case 9 over 12. So that's the only other trick to this. Regardless what management uses, even though straight line is favored by 83% of them, right, or more, regardless whether they use straight line, accelerated, or the units of activity method, guess what? They can only still write off the $12,000 for this truck. So regardless what Bill decides to do in terms of what method he wants to use to depreciate the truck, it doesn't matter in the long run, because after the 5 year period, he can only still expense 12 grand. Just in straight line, as you see, it's constant over each of the 5 years. In an accelerated method, which is what declining balance is, most of the depreciation is taken in the very early years, and less so as time goes on. Units of activity is simply, in this case, because it's a truck, the number of miles that Bill's truck was driven that year. This is a per mile output. But again, you can't expense more than what you're using for the business. So again, it doesn't really affect, it will affect income taxes for companies that don't use a straight line method. The IRS requires a straight line method. The IRS does provide an alternative depreciation method called MAKERS, except MAKERS is used for taxes and not for reporting. So because we're looking at financial accounting from a reporting perspective, MAKERS is not acceptable for GAAP, but straight line is. All businesses have to disclose what depreciation method they use. So again, here, this is Southwest. They have straight line depreciation. They say their flight equipment is going to be used between 23 and 25 years. Their ground equipment between 5 and 30 years, depending on what it is. They have to list exactly what they're doing in the notes. One other thing that needs to be talked about regarding this is sometimes assets are permanently damaged, what we call an impairment. There's a permanent decline in the value of an asset. When this happens, the company has to write it down that year, but you kind of know that it's happening. It's not something you can just pick and choose. Oh yeah, this truck, we're just going to make an impairment now. So impairments happen normally when it's very clear that the asset that you were using or were hoping to use in a certain way just simply cannot be used in that way. For example, when Disney does a movie, what they used to, they've gotten much better at making movies. But back in the day, they created, I think, a movie called Waterworld way back. They spent millions of dollars on it. It flopped. It was a flop. Well, the literal cost of the movie is the value of the movie on their books. But because it was an immediate flop, they wouldn't. They pulled it literally within a couple of weeks of it opening. They pulled it because it was just no one was going to see it. Basically, they had to create an impairment in the value of that asset. And remember, for companies like Disney, stuff like that, movies are intangible assets, and they work, as you'll see next class. They work very similarly in terms of how they're valued upfront. So that's one of the things. For those of you that have followed one of the most popular cannabis companies ever traded on Robinhood, something called Aurora Cannabis. They went on a buying spree a few years ago. They bought a whole bunch of facilities 2 years ago, really, to grow marijuana, and they paid a pretty good price for those facilities. But of course, the demand for marijuana never increased, so they really couldn't use the facilities. Um, so that asset, which they thought was worth something, isn't really worth much of anything because they're not able to use it. So that's an impairment for that company. They have to write all that stuff down. So again, these things happen. That's why it's mentioned, but you should know what an impairment is. And that, my friends, is the first two objectives for chapter 9. Questions?